smile through. Good morning to you.
Okay, welcome everybody. Happy Friday to Simon's Quarterly Virtual Coffee. Hope you've got your preferred beverage in hand. In my case, it's a skinny cap, my second for the day. So I'll try to let the caffeine work its course through the system without talking too fast. Hopefully, if I can ask everybody to mute their microphones, that would be great. And we will get started. The screen before you should show the agenda for the day. We'll start with a review of the returns to the main investment asset classes, looking at some diversified portfolio returns and updates, and then a couple of different processes around if you're putting money into the market or you're taking money out as well. We're getting a bit of interest in that at the moment with all the volatility or increase in volatility we've seen since sort of mid-February, mainly driven by what's happening in the US. Excuse me. And then we'll finish with a really cool cashback idea that I've discovered. And as if any of you have watched me before, you'll know that I love the cashback schemes. So this one has a bit of a twist. Just a reminder, this is general advice only. So if you have any specific questions in relation to your situation, don't hesitate to drop me an email or book a call with me. There's a book a call button on our website, top right-hand corner on the homepage. So we'll get started. First of all, we'll have a quick look at the quarterly review from our research team at head office. Again, this should look pretty familiar. I'm just going to cherry pick the main highlights from the first quarter. Just bear with me 1 second. I want to make sure we're recording. Yes, we are. And I think, as it says here, and not repeating stuff that isn't already known, the second half of the quarter was pretty ugly in share markets because of what's happening in the US. And I think when Trump was elected, shares went higher. A lot of optimism, as it says here. There was expectation that it would be very pro, and his policies would be very pro growth, pro deregulation, etc. That's all sort of reversed since, particularly since the 2nd of April, where Liberation Day, as Trump called it, with there's huge amounts of tariffs being proposed on many parts of the world, particularly China, one of the most severe. And so that's really, in terms of the single biggest impact on portfolios in that quarter would be that news, basically, the uncertainty around how much Trump's tariffs are going to impact the economic outlook, and then by definition also share and investment returns from your portfolios. Again, just focusing on Australia, a couple of highlights. Inflation is still fairly stable around that 2.5% mark. So that's potentially a positive for further rate cuts if you do have a mortgage. I noticed the last couple of weeks there's been speculation of more rate cuts as a bit of a buffer for what's happening in financial markets. I don't think the RBA pays too much attention to that. They're more focused on the underlying data. So they've got to get economists and strategists on TV making predictions and giving them something to talk about. But my view is the RBA wouldn't be too swayed by volatility in shares or market corrections, etc. So I take it all with a grain of salt. House prices have started moving again, so pretty much close to lifetime highs in terms of the combined index of house prices in Australia. We know about this because we're in the middle of an election campaign, and top of the list for gripes with voters is housing costs. So again, just backdrop to what's been happening in house prices. I'll look at our usual table shortly on returns from the main building blocks of portfolios, or in other words, the asset classes. But again, what I think is interesting takeaway from the first quarter is, although global shares in aggregate were down, and that's measured by if we look here, the 3-month, where my cursor is, the 3-month global shares, second last item. Let me zoom this a bit. Oops, sorry. Down 2.4%. If you dig deeper into different sectors and regions, it was really the US that brought, because of such a large weighting in that measurement, it brought the returns down. But other sectors or regions have actually had positive growth. Europe, for example, and emerging markets. So you can see here, emerging markets actually made money in that quarter. Again, a quarter doesn't make an investment strategy, but just in terms of commentary as to what's happening, within the index or within the broader measure, because these are broad measures, and quite often there's a lot of nuances below the water, so to speak, or below the line. So the point in that is this diversification going on within your portfolios, that just what you read and hear about in America isn't necessarily exactly what's translating to your returns. And a great example, as I said, is emerging markets, this one here. So for many of you, where we can, we've introduced some exposure to emerging markets in the last year or two for those clients that are working with us. And that's, as you can see from the numbers here, acting as a bit of a buffer and a diversifier, which has been a smart move. So if we move across to our old faithful table here, these are the returns to the end of March. So these are the building blocks of most people's portfolios. Your return would be an aggregate or a weighted aggregate of how much exposure you have to each of these different areas. Again, if you're working with us, we maintain a fairly, industrial, sort of well-publicized protocol to maintain diversification, keep an eye on costs, risk, and so forth. But the 10-year is the grey line in the middle of the table. You can see that even after recent weakness in shares, on a 10-year basis, Aussie shares have still done a compound return of about 7.5%, including dividends. Global shares about 11.9, call it. Even on a 12-month basis, looking back, in spite of all the news in March and April, you can see that shares still actually have had a positive return. So I guess for 12 months, the thing to take away, as always, is there's a lot of noise and short-term volatility. A lot of it's random, and to focus on the longer game, as always, right? We're hunting, as I said many times, we're hunting in this area here, the 10 and 20-year timeframes and horizons to get that premium of returns from things like shares, etc. But it isn't a straight line, as we discovered with severe volatility in the first half of April in particular. But a lot of that's recovered in the second half. So the March diversified portfolio returns here. Hopefully this table looks familiar as well. But this gives you an idea of what a typical blended or diversified portfolio might have returned. Again, not necessarily your results, but hopefully within the range of these numbers. If we pick the 70-30, where my cursor is here, that's sort of a fairly average. A lot of people sit in that sort of 60-40 to 80-20 range. So we'll just use 70-30 as a guide. 70-30 means 70% of your portfolio in stocks of some form: property, global shares, emerging markets, Aussie shares, maybe some alternatives if that's your thing, etc. And 30% in cash and bonds, right? Or term deposits, cash, bonds, so forth. And so the 1-year returns relative to when we did this exercise for the December quarter are definitely lower, as you'd expect, because shares, which are 70% of that return, have been rolling over. Still pretty healthy. 10-year result just under 7%. Again, this isn't necessarily a guide or a guarantee of the future, but it's a guide to the future. And the more important thing, I think, is to in your mental preparation and the mental games in our heads when we're seeing particularly bad news, the bottom half of this table shows measuring returns from all these different portfolios over the last 30 years, the best year that you've had and the worst year that you've had. So again, if we pick the 70-30, looking at all the data points, so every single month, looking back 12 months for the last 30 years. So again, quite a deep set of data, which means that it's a reasonably reliable indicator, certainly of the past. The best year you would have had in a 70-30 diversified portfolio would have been 28% as a guide. but the worst year is a 23% return fall on paper. Only a loss if you sell. And so it's a good segue to the next part of the chat, the workshop, which would be what are ways to kind of mitigate some of that downside if you are putting money in or taking it out. So we'll get to that shortly. Last but not least, with tracking and performance, we roll out the good old Vanguard 70/30 again as a guide to another way of looking at portfolio returns, as a guide to what your portfolios might be doing. So this is again, the 70/30 fund here. Where are we? Growth index fund. So that's approximately 70% in stocks, 30% in cash and bonds. Again, just as a guide to what's been happening. If we scroll down here to the 5-year chart, still, again, putting things in perspective, and this is why lengthening the time frame really helps with if you are nervous about short-term drops in the market or the value of your portfolio, you can see that it's really just a blip. So this is the value of the price of a unit in this fund, going back to the last 5 years. So if you started with $10,000 the end of March 5 years ago, even with the recent falls in the value of shares, you can still see it's worth 15,000 odd or $15,500. So extending the horizon is a great perspective, a great tool for reminding us that that investing does work, owning stocks does work, but it isn't a straight line. As you can see, plenty of dips along here in this chart, but overall, if you drew a line from here 5 years ago to here, it's still an upward trend. And obviously we could expand that longer and longer. And over time, it always goes like that, but there are dips along the way. And it's managing those dips is the most important thing, keeping you invested so that you can earn those returns and sit in your strategy and stay with it when there are dips. And as you can see, in the quarter, this portfolio was down about 1.4%, but still up about 6% for the year, still up about 9 odd percent for the last 5 years. So again, perspective, right? Lots of noise and fear, particularly the first half of April, but really big picture, overall things are still tracking well and within long-term ranges. So it's really just about staying the course. So speaking of staying the course, if you are in a fortunate position of putting money into I've just got a question here, so I'll come back to that at the end. Thank you. If you are fortunate enough to be putting money into your portfolio, but you're worried about mistiming the investment, particularly if it's a larger amount, or and when I say larger, we sort of define that as maybe 10% or more of your account size. So if you've got $100,000 account, you're putting in more than 10,000. You may want to consider drip feeding it, or one program is what we call the dollar cost averaging. And this is a systematic or automated way of investing. In this example, let me zoom a bit. We're talking about basically a set amount of money over a regular period, and it just goes on autopilot. And so in this example, if you had $12,000, you could do $1,000 every month, maybe the first of the month or the 15th. I think the important thing is to set it up and then not change it, right? To stick with the plan. Why is it important, particularly when, again, we are seeing more volatility in stocks? It reduces the uncertainty and the stress of having to make a decision. Do I buy now? Do I wait? Is it going to go lower? Is it going to go higher? Which is really a market timing exercise and quite fruitless. So it takes that pressure away from having to decide, and it also smooths out the market ups and downs. You're less likely to mistime it, so to speak, if you spread those investments out over a period. So very useful for times like now when there is market volatility, or as I said, you've got a large lump and you just, you don't want to take that bet all at once. And again, it reduces the risk of poor timing. Great way to build wealth over time. So a classic example is if you may not be aware of this, if you are contributing to super, either voluntarily through something like salary sacrifice, which is a periodic deduction from your payroll. Likewise, your employer contributions, same thing. So whether you realize it or not, that's actually happening in your plan, in your super right now. So this isn't a perfect solution. If we had a crystal ball and we knew the market was going to be higher in 12 months, or whenever in the future, we would do that now. We'd invest it all now. So it doesn't work perfectly, but the idea is to keep you invested, to keep you sticking to the plan. And in our view and our experience, this is a great way to do it for the scenarios that we talked about. As I said, the one time it wouldn't work is if the market went higher and you could have bought them now. But it's, in our view, this is still, it's not a purely financial thing. It's also an emotional thing that you're feeling like, it's a less stressful journey for you. So that's a way to add money to your portfolio in a systematic approach that doesn't require you trying to guess what the market's doing all the time. We also have plenty of clients who are fortunate enough to have retired or financially independent, and they're doing the opposite. They're actually drawing money out of their super pensions, etc., as in your own private pension. And in a reverse logic, they have the same issue: is it now a better time to sell to raise some money if prices are going lower, or should we wait? So it's the same emotions, but in reverse in terms of the direction of money. It's coming out of the portfolio, not going in, but we still want to try to get good prices, right? When you're going in, you want to get the lowest prices. When you're coming out, you want to get the highest prices. And so one strategy we use for a lot of clients is a bucket strategy. For some of our clients, we might not use that language, but effectively it's what's going on within their portfolio, because we spread the money around in different investment areas, which broadly fit into 3 buckets. And so each bucket has a different purpose and a time frame. We've got a cash bucket, an income bucket, and a growth bucket. Let me zoom this again. And this is quite a good way to set up a drawdown or with a regular withdrawal process. And I'll just skip to this one here, second page. And the way it works is the first bucket is your cash bucket, where you have maybe the first 2 years of drawings. So if you're drawing $50,000 a year to live off in your retirement, you might have $100,000 in the cash bucket. The next bucket is the income bucket, which is what we call the medium term. So you might have the next 3 to 5 years worth of planned spending locked away in that bucket. So that if it was 50,000 a year, it'd be 150 to 250,000 that you would park in the income bucket. And then the last bucket is the long-term bucket. So 5 years plus, everything else goes in that bucket. Hopefully there's enough money in there to last you if you've done the work and you've worked with your advisor or with me on the projections and the what ifs. Then the chances are you're in good shape. That's why we're here, right? Because we want to take advice and try to do the right thing. And that's really where you put the growth assets, right? The stocks, anything that's going to grow over time, but also has the most volatility along the way. And that volatility is what can hurt you in terms of the timing of when you want to take money out, just like we're talking about when you put money in as well. How can you mitigate that timing risk? And so effectively, what the bucket strategy does is buy you time, because if it's a year in which share prices aren't great, then you don't have to sell the shares in the growth bucket, because you've already ring fenced or farmed away at least 5 years of planned spending or drawing in the first 2 buckets, the cash bucket and the income bucket. And also you're also earning money while those 2 buckets are sitting there undrawn as well, because the income bucket is invested in perhaps some term deposits or fairly high quality bonds. And a bond is a promise to pay by someone other than a bank, right? A term deposit, you put your money with the bank, and in a year's time you get an interest rate or an interest payment and your money back. A bond is a partly similar structure where you place your money with a borrower like the Australian government, because they're spending more than they're taking in taxes, as we know, or many other governments for that matter. And then in a certain period in the future, they'll give you your money back plus an interest rate. And the reason that's attractive is usually you get a higher rate than just leaving your money in the bank. because you are taking a little bit of risk that the borrower won't pay you back. So you're compensated for that risk. But the way we build these portfolios is to have high quality bond issuers. So you're giving your money to counterparties that are highly unlikely not to repay you. So first world governments, OECD governments, very large, high quality corporates with lots of cash flow, but they part of their financing is borrowing money from investors like you. So that's where we sit the income bucket, because you want to know that your cash and income bucket are going to be there no matter what. The growth bucket can do its thing, and so times like now where short-term prices are down, with the value of your investments, we don't need to touch that. And in fact, we've got a lot of breathing space if things get worse. We can lean on the cash and income bucket for many, many years. And so hopefully for most of our clients, it takes away that anxiety. Even though when you look at your account balance, you might see it dropping. It's only, as I mentioned before, you're only crystallizing that loss in hard dollars if you're selling the assets that are dropping in value. So the idea is we're drawing from cash first and bucket. And in good years, when we've had a strong return in shares or that growth bucket, whatever investments they are, is when we harvest some of that. And again, clients working with me would have heard me using that term: take some profits off the table, harvest the shares, let's refill the other two buckets. And so the role of a proactive investment strategy, whether you're doing it yourself or with an advisor, is to regularly and periodically check the three buckets and make sure that they're being refilled when the opportunity comes. And the last couple of years, we've seen quite strong returns. So for most of our clients, we've been harvesting some of that growth and filling up the income bucket and the cash bucket where required. So it works really well from a sort of a mental and a literally accounting point of view, because there are three buckets, right? You can see where your drawing is going to come from. As I mentioned, you're not forced to sell off your good quality long-term investments. Sorry for that toolbar getting in the way. During times like now, when shorter-term share prices are dropping, and so it keeps your money growing and compounding, because, excuse me, you don't need to touch it for a while. And so, as I said, it's important to regularly review it, whether you're doing it yourself or working with an advisor. And you can tailor this, right? You can have larger buckets, smaller buckets, etc. So again, these things aren't perfect. You might have a bit more cash or conservative assets than you would otherwise. But again, the idea is if this helps you stick to the plan and not abandon the whole investment strategy, in our view, that's worth a lot more than a few extra dollars. So that's just something to keep in mind. The idea is to make your journey emotionally as smooth as possible, as well as hitting your financial goals. So that's smart ways, in our view, systematic rules-based approaches to either putting money in with the dollar cost averaging plan, or taking money out with the bucket strategy, using three different buckets depending on market conditions. Last but not least, my fun part of the workshop. Let me have a bit more coffee. So here's another cashback scheme I have discovered, which I think is really cool, because most cashback schemes will give you cash, as they say, cash back. This one actually gives you the option of automatically sending that cash back to either your mortgage or your super. Just to take a step back, what is a cashback scheme? It's basically like it's called affiliate marketing, right? But effectively, this website gets a small commission if you click on the retailers listed in their website to do your shopping or do your purchases or subscribe to Foxtel or book an Experience Oz coupon or whatever. And so I have talked about these in the past. We as a family are big fans of cash rewards. There's a few others out there. That's just the one we're comfortable with and used for a long time. So, the idea is there's no extra effort on your part or cost. All you need to do is just form the habit. Whenever you go to do some online shopping or go to buy a voucher online, you go through your preferred cashback provider, and the first stop is to see if they offer any deals. And it's as simple as that. It is an absolute no-brainer. I know my family and friends are sick of me going on about it, but to me, it is free money. We're not talking about huge amounts of money, depending on what you're purchasing. But from time to time they're special. So, we buy a lot of sports gear for the girls and for ourselves, we're going to the gym and exercising. So, things like Asics, Adidas, Nike, whatever. Sometimes they'll have specials where you might get a 20% cash back, but capped at a certain dollar. The point is, keep an eye on your preferred provider, register with these guys. It doesn't cost anything. The difference with this particular scheme, Grow My Money, is they also offer the option of sending the money to your super or your mortgage, right? Which I think is brilliant because, again, I don't know if anybody's read the book Atomic Habits by James Clear, but what we like to see with our clients is automation, systematizing stuff, so you don't have to think about things. So your plan is taking care of itself, just running in the background. And so what I like about this scheme is that you do your shopping you would have done anyway, your online purchases you would have done anyway, and behind the scenes you're getting a couple of bucks sent to your super or to your mortgage. And I think that's, again, just another way of forming those habits without really even have to think about it, right? You weren't going to see the money anyway, so why not progress your longer term future by paying the mortgage or sending it to, sending it to super. So it's that simple. There's a section here where you register either your mortgage or there it is, my super. And pretty much works with any super fund. I'm focusing on super because that's obviously a big part of what we do for clients for all the benefits. Yeah, and so the main thing, of course, to be aware is if you what your limits are, how much you're putting into super already. Again, if you need help with that, don't hesitate to book a call. And the alternative, of course, is the mortgage option here for people that have mortgages, so or would prefer to pay off your mortgage. And so the question, mortgage versus super, again, because this is a general chat, it all depends on your personal circumstances. If you have a mortgage and you want to be boosting your super, that's where sometimes we'll do some scenario analysis for our clients to figure out which one might be better. So that's my my money hack for the quarter. Again, friends or family that do a lot of online stuff, or even yourself, whatever, you're buying vouchers for various retailers. I can't stress enough, this stuff is an absolute no-brainer. Even if you don't use this particular scheme, find one that you like and get yourself a membership, which, as I said, there's no cost for doing that. So I've got one question here. That's right, that's a good question. So question one, Sophie, thank you. Loan returns and cash defense part of the portfolio. Yeah, I guess so question is and we get this from time to time about let me go back to, so we're doing the Q&A now. We're at this section here. Question about historic bond returns, whether or not as the defensive part of the portfolio. So this is the question here. I've got Sophie asking me and the effective takeaway of the question is, global bonds and domestic bonds generally form part of your defensive, or if you're a 70-30, there's 30% in cash and bonds. Is that such a good idea, given the historic returns of the last 5 years where you pretty much have been flat? The main reason bonds had poor returns was effectively a once in a 40-year event, which was a massive spike in inflation. I won't go into how bond maths and bond pricing work, but anyone can Google that if they want a bit of education on bonds, or ask me on the next review. And so that's the one that sticks out when people look at this table and go, well, why would I own bonds if that's the return? Again, the important thing to think about when you look at these numbers is not so much about the past, but what would things look like in the future. And if you, again, extend the time frame, what we saw with bond returns in the last 4 or 5 years was sort of a once in a 40-year event. So our expectation isn't that would happen again. Obviously, if we knew that, then yes, the answer would be your 30% should be in cash or bonds that would be lowly or minimally impacted by inflation spikes if you were worried that was going to happen again. So it's a good question, but yeah, the best of our knowledge and views and the general consensus that is unlikely to happen again. And in terms of cashback providers, I think in terms of the question is which cashback provider has the most retailers? It's personal preference. In our view, Cash Rewards is great for our family and our needs. If you think of it this way, it's in their interest to have as many as possible because they want to drive traffic to their website, the cash providers. There's only 2 or 3 main ones. And again, I just mentioned this new one today for because they have a twist or a point of difference that you with Grow My Money that you could send the money to super or your mortgage. But the answer is, and then the second question on the cashback scheme from Sophie was, do they send the cash back to your account? Not directly. So it's again with my experience with Cash Rewards, you have an account with them. You log in, etc., and your money sits there, and it's up to you just to periodically sweep it across. So I do that sort of quarterly. I keep an eye on it and send that to so you link your bank account, but you can do it as often as you want. I think the minimum for Cash Rewards is once your balance reaches $10, you can transfer it across. I think with the super one, I think it's only $1, and they'll pay it across to your super with Grow My Money. So it's details are in the devil's in the detail. Read the fine print, but as I said, from everything I can see in our experience, there's no catches. So thank you for those great questions. You're welcome, Sophie. Thanks for tuning in. So again, just to recap where we've been, where we're going, I think looking at those longer term charts, keeping that long term perspective is really certainly gives me peace of mind that what we've seen again, particularly the first half of April, is the normal course of investing, right? If you want to earn those returns, you're going to have periods of a little bit of emotional pain and paper pain. It's only real pain or financial pain if you sell. And so hopefully we've shown you some ways to, if you are taking money out or putting money in, some systematic rules-based ways to help you remove that emotion, and we're here for you as well. And then hopefully some great ideas to get some free money. Again, general advice only. If you need any specific help, don't hesitate to book a call. And thanks for watching. Have a nice weekend, everybody. I'm going to go heat up the rest of my coffee. See you later. Thank you.
So good morning, sunbeams will soon smile through. Good morning to you.